Welcome to Agency Acquisitions and Exits. I'm your host, Peter Lang. Today's guest, Jon Morris, founded Rise Interactive, his second agency, scaled it from zero to over 40 million in revenue, sold a minority interest in the business, and then a majority to the same shareholder and partner, and then crushed his earnout. He is a rare entrepreneur who grew 75% per year during his involvement in the business. And the company did even better after he left. This conversation spans 20 years of learning, from bootstrapping Rise out of a business school competition to growing and unlocking financial systems for 8-figure firms. If you are at a place where you want to scale your agency, you want to think about how to do it properly and what matters most, this is the session for you. Let's dive in. Jon, thank you for joining me.
Great to be here.
Run me through the business school to the multiple agency and then the exit timeline, just so we can compress for the audience, and then we'll go in deep.
Well, it's actually right out of college, I started my first agency, Net Traffic. I grew it for 5 years, became a .com casualty. I then went to business school. I went to University of Chicago for business school, entered their annual business plan competition, took second place, won $10,000, used that as the seed money to grow Rise. Based on the learnings from business school and the learnings from my failures of my first agency, I was able to grow Rise from zero to almost 40 million in revenue in 16 years.
So we can go back in time and just advise all kids out of university to fail at the first venture, go back to business school, and then do it again.
I think that if you can learn from your first mistakes, I think it's a great strategy.
When you and I were talking, there was family pressure involved. I loved that storyline into what you've created in Rise, because it was, to me, it's like the hero's journey.
Yeah.
Share with the listeners kind of what your family temperament was to you being this entrepreneur in the digital agency or the agency space.
So, I'm approaching graduation from business school, and my parents invite me out for dinner. And I think I'm just going out to dinner with my parents, and my grandma's there, and we sit down, and it turns out it was an intervention. And they mainly wanted to talk me out of trying to run Rise. They wanted me to participate in on-campus recruiting at University of Chicago before that window closed. And they were really scared that, that this business wasn't going to succeed. I missed this window of opportunity. And so I ended up creating milestones. That was how I got them to back off a little bit. I was like, I got to hit this revenue number. If I hit this revenue number, I'm going to keep going. If I don't hit this revenue number, I'm not going to keep going. And I hit that revenue number, and then I hit the next milestone, and then I hit the next milestone. And very soon I was doing much better than the opportunity cost in terms of like what would have happened if I went and took one of those jobs from business school.
You described yourself as an incrementalist.
Yeah.
Was that environment, the family pressures that got you there? Are you wired that way? Like, what makes you an incrementalist?
Might be my Midwest upbringing. I like to have very clear milestones. And, the idea is that if you make small improvements and lots of them over time, that compounds into a really big number. And so all I want to do is I want to know that 2025 is better than 2024. And then I want to make sure 2026 is better than 2025. It doesn't have to be, that you grew by 20 million %, in a year. If you can consistently do 20% growth, that's doubling every 3.8 years. I think a lot of business owners will be really happy doubling every 3.8 years. And so that's kind of my mindset of how I like to look at business. I also, in business school, a lot of what they teach you is you go raise money from a venture capitalist, you get this valuation, then you go work hard and you have this big exit. I like to have a different approach. Just build a great business. Don't even worry about the exit. I promise you, if you don't worry about the exit and you build a great business, you'll get the exit you're looking for.
Yeah. Take us back in time. What were some of the shortcuts, lessons learned that you were able to put into Rise that you didn't have in the first attempt?
Yeah. So I started my first company literally 2 days after I graduated college. Spent a day moving, and then I start the business. So I'm 22 years old, and I was scared to fire people. although I was good at numbers, I didn't understand the importance. I didn't have good discipline with finance management. And when it failed, I played soccer in college and I'm a big team sports guy. And, I really started to think about I need like the same quality of team that I would want like on the soccer field in my business. And so if you start having that mindset of do I have an all-star team? Is this person the absolute best for what I can afford? And if the answer was no, then I was going to get rid of that person. In fact, in 2026, I fired 50% of the people I hired. And, you know, people thought I was nuts. But I knew, what happened is in this interview process, people were able to convince me that they were analytical. But then when I actually hired them and they started working, they weren't analytical. And I ended up creating an analytics exam. It had a 22% pass rate. And I was able to start weeding out people who could, fool me in the interview process. But I was able to put together this insanely talented team. I can't tell you how many people who work for competing agencies now that have hired people either from Rise or after they left Rise, who just talks about what amazing, talented people they are. And so I think that was one of our big secret sauces, the quality of people we were able to hire. And then the other one
That's a
was, sorry,
I was going to highlight that that was such a vulnerable and true statement that a lot of the early days of agency growth, new prospective hires convince you they can do the job and you don't know better. And so you oftentimes get people on your ship that you have to remove down the line or should remove quicker. Just give us a sense, like Rise at its peak had how many people?
250. Well, 250 when I left. I think it grew up to about 400, 500, today. So it's substantially larger.
And would you say in the early days you were hands on in hiring up to how many? Yeah. And how many did you
Maybe,
fire out of the first 50?
I
Ton.
mean, a lot. I had a saying that nothing's more important than your direct report. And I held managers accountable to their direct reports. And if I felt that the quality of their direct reports was not at the level that it should be, there would be a lot of pressure on that manager to either train them and get them up to speed or replace those people. And, I like this concept of dumb flows up. Like if I could be the dumbest person in the company, and the people who report to me are the second dumbest people in the company. And the people who report to them are the third dumbest people in the company. You're going to build an amazing company. And so I really want like the people I hire to do their jobs better than I could do their jobs.
What did your life look like in those early days? Because no wife, no kids. So, like, what did this obsession of Rise look like day to day, and how'd you fill your time?
Yeah, look, I'm willing to bet it was very similar to how hard Elon Musk worked. Massive amounts of all-nighters. I had a client in Florida that was one of my largest clients. I moved to Florida for 3 months to go take care of that client. I used to be excited about holiday weekends because I was like, the world stops, but I get to keep working, so I get to catch up and do more work. So there was a lot of determination and a lot of intensity. Today, I have a wife, I have 3 kids. I just spend a lot of time with my family. So I'm not doing all nighters and I'm not doing the same work. But I believe in work-life balance. But I believe that when you're in work, intensity really matters and that you need to build a culture of speed and aggressiveness so that you just get a lot done in a very short period of time.
Well, you took Rise from 1 million in revenue to over 40 million, and you also then sold the business. So, describe some of that intensity. Like, what do you think made you attractive to prospective buyers? You talk about build a great business and buyers will come. What were some of the things that you were really proud about in the business that you think also made it really valuable to the market?
So a few things. I'll start with we were one of the first companies to truly take a data-driven approach to marketing. So that massive amounts of media was leaving traditional media and moving to digital media. And in my opinion, the skill sets for digital media where everything was measurable is very different. A lot of people went into advertising and marketing because they didn't have to do math. And all of a sudden you have to do massive amounts of math. And so we recruited very heavily from the financial industry. So I was really proud of our recruiting, our training, our onboarding, and the quality of our talent. I was really proud of our granular nature so that we were able to identify waste and redeploy that media from that wasteful spend to positive ROI places better than anybody. We spent 8 figures on a media analytics platform that helped us identify that waste. And then here's just a good example of the intensity. I had an employee of mine who worked at Discover Card before he came over. And he's like, I told him, I was like, look, I just want before you start here to warn you, like, you're not going to experience a culture like this ever before. Like the intensity here is just at a different level. And he's like, John, he's like, I'm the hardest working person at Discover. I promise you I can handle it. And I was like, okay, so we'll see. So he comes on over. I check in with him about a month later. And I'm like, so how's it going? He's like, I now understand what you mean by the intensity. He's like, when I said I was the hardest person working at Discover, he's like, I really was. But if I ever wanted to slow down to the speed of Discover, I could. He's like, anytime I try to take a breath and like slow down, it's like I'm getting text messages, my instant messenger is going off, I'm getting emails, my phone is blowing up. And there's this constant like, where's this deliverable? How are we doing against it? And that speed, I think, allowed us to get stuff done faster. And I'll just give you one quick example. I demanded that every single one of my account people get back to a client within 30 minutes or less. And doesn't mean you have to have the answer. It might be, hey, I just want you to know I got this. I'll get back to you in 2 days, with the answer. But I believe that speed matters, and people, when they have a question, want a response rate, a response. We won deals before even competitors replied to an initial inquiry. So there's just lots of cool things you can do when you have that speed and that intensity.
What were some of the metrics that mattered most in the early days? And then you say those metrics changed as you got bigger and you scaled.
For the company or for my clients?
Ooh, that's a good point. Let's do for the company first, but I don't want to miss this client comment.
Yeah. So I believe there are really only 3 numbers that matter. There's 3 numbers that mattered when I was at Rise. There's 3 numbers that matter today. For your audience listening, I believe there are only 3 numbers that matter. The first is how much cash do you have relative to monthly overhead? I'll be honest, I did not put enough emphasis on cash. Like if I could go back in time, I put a lot more emphasis on cash in the days of Rise. The second one is your profit margin. You should have a 20% profit margin if you're in the service-based space. And then the third is your revenue growth. I want you to average 20%. We average 75% year over year growth over my 16-year period. So those are the 3 KPIs that mattered. When I get a little bit lower, like or deeper, there were a few that are key to the success of those numbers. The first is your gross margin. How profitably can you service customers? Most of the people I talk to before they start working with me have no idea what their gross margin is. And if you're a $20 million business with a 50% gross margin, you have $10 million to invest back in the business or put in your pocket. If you have a 30% gross margin, you only have $6 million to invest back in your business. And so we put a huge amount of emphasis on gross margin. When I left, we had a 57% gross margin, which gave us a lot more money relative to our competition to invest back in the business. The second key metric we focused on is what percent of our revenue do we spend on sales and marketing? My goal was to spend the highest percent possible of our revenue on sales and marketing. And I can't tell you how many people came to me as like, how are you growing so fast? I would ask them, I was like, well, how much do you spend on sales and marketing? It's like, oh, it's all word of mouth. It's like, well, you don't really want to grow if you aren't investing in sales and marketing. My responsibility is like, well, how come I'm the only marketer that believes in marketing? Because if you're a marketing agency, you
Yeah.
should believe in marketing. The next one is my number one sales goal is never lose a client due to performance. So we spent a large percentage of our revenue on innovation as well. And we would constantly think about how do we reduce churn? Because if I can make it so our business was better at the end of the year than it was at the beginning of the year, then going back to my incrementalist philosophy, like over time, if I'm making those investments and my competitors are not making those investments, we're going to have an amazing business.
How much of this was intrinsic versus externally influenced? Because, I mean, at the end of the day, you were growing very quickly. Were you tapped into competitors? Were you not focused on competitors?
A couple of things. I was obsessed with competitors. I'm still obsessed with competitors. I always want to know that what we offer is superior. And so the only way to do that is, first of all, really listen and really understand what people are doing and give credit where credit's due. The second thing is, I'm a big believer in putting advisors together that give you insights into the business. So my mentor at Rise was a person named Jack Kraft. He was the COO and CFO and vice chairman of Leo Burnett, and he was involved in taking multiple digital agencies public after he left Leo Burnett. And so, I just was a sponge. I mean, a lot of what I do today was things I learned from him. I have a person at my current company, the chairman of our company, a guy named Jim Bauman. He was the CEO of a company called Followed Education and took it from 500 million to 1.2 billion. So I think it's really important to surround yourself by people who are smarter than you and people who have learned from their own mistakes, other people's mistakes, as well as their successes, so that you can spend your time and your money more intelligently.
Right. Yeah, you emphasized that in our prep, which was you can tell the difference between a lot of companies' potential by whether or not they have board advisors, who they're going to seek counsel, because it's key. You're reinventing the wheel if you don't stand on the shoulders of those who come before you.
Exactly. It's a foolish thing. Like, you should never have a monopoly on all the good ideas. Like, you should try to take as many good ideas from as many people as possible.
I want to challenge your build a beautiful business or the best business possible concept in your exit. So you're there working, you're growing rapidly, you're proving your family wrong, which is even probably the best outcome from this. You meet your wife during this time. When did the idea of selling transition from I know it happens, I know it's going to come at some point to it's coming in the near future?
When you start really with very little wealth and you grow an asset that becomes 99.9% of your wealth, and then you have a wife and you have kids, you start thinking about diversification and you start thinking about preparing for the future. And so, my priorities shifted. And there were some personal reasons why it was good timing for me to sell, but those were some of the factors that went into it. So, look, I think I mentioned to you this the last time. My original exit strategy was I was going to die one day. And I really I loved what I did and I felt I was getting paid well for what I did. And so there was no need for me to really think about doing anything different. And then life changes, and so when I sold, it was the right time for me to sell. If I could go back in time, I would do it again. I don't have any regrets on that decision. I love what I'm doing now, in terms of helping service-based companies manage their finances, do strategic planning. I love the building of technology. I wake up every day loving what I do. And so I feel very fortunate that my next act, which is my third act, is a really cool act that I enjoy.
You talked about the motivation aligning personally and professionally for you. Take us back in time. When did the buyer reach out to you and how did it feel? Did it feel like the stars were aligning? Like, what was some of the initial reactions to it?
So it goes back to 2015, 2016, where I decided for the first time to get outside capital and to take some chips off the table. And I looked at private equity. I almost did a deal on the private equity side. And then I came across Quad, which is the largest printer in the United States that wanted to diversify their revenue and move into the marketing space. And they um, they came across as the right partner for me. So it's more of a strategic. They have some of the largest clients in the world. They have a large sales force. They were looking to put lots of money behind this. And so I ended up doing a minority deal with them. And I really got to date for 2 years. So when I sold majority ownership in 2008, and then I went on Earnout for 2 years, I didn't look at anybody else. So I didn't go hire an investment banker and do a full process. I felt like I found the right buyer They are beyond wonderful people. I can't speak highly enough of Joel, the CEO, the leadership team there, and culturally, I just think it was a great fit. And same thing. Like if I could go back in time, like they'd be the buyer.
Help the listener understand what selling a minority stake in your business that you've been running and growing looks like.
Yeah. So, in my scenario, I was in a very fortunate position where um, I was able to maintain control. So if you have 51% ownership or more, you basically still get to call the shots. You get to run the business. It's your leadership.
It's still yours. Yeah, it's still yours in many
It's
respects.
still mine. And also the operating agreement was very favorable to me. Like I had a lot of control within that, position. They also treated me very fairly on the valuation. Like they were a great minority investor and they really put the time in. So like if you're taking a minority investment or a majority investment, ideally you're getting more than just money. And you want strategic guidance, you want introductions to clients, you want, a partner that's going to help add fuel to the growth of your business. And I think Quad absolutely worked really hard to deliver on that promise.
Well, I was going to ask you about that promise because it's interesting. You mentioned the operating agreement. Were you still the manager, or
Yeah.
how did this might be helpful for the listener who's not used to having partnerships where you have an active operator versus just, a more passive involvement. So you were the manager of the business. There was rules by which you would operate the business under, but you had full control. It sounds like.
Yep.
Did you negotiate that, or did they come to the table like that?
It was a negotiation and there was definitely some provisions. I don't remember all in the minority agreement, but I remember some, I think in the majority agreement in 2018. I think like I was still the operator of the business. I think like if I wanted to make any expenditures over 250K, I needed permission to do so. Or I don't remember all the details, but there were certain guidelines that, you needed to go to the board to seek approval for. That I think are very fair. Like they're trying to say, look, we're going to give you a lot of leeway. You can't do absolutely everything you want. We're a partner and you got to, be a good partner.
What was the biggest difference, because they sound like a great partner, from running your own ship to having a partner? Was your reporting changed? Did you approach the business any differently?
So I would say overall, they were a phenomenal partner. And I think we had a really good, structure and relationship. They're a large company, 22,000 employees and are publicly traded. And so, just like closing the books, like we had to close the books within 4 business days after the acquisition. And there was a lot of reporting and information that I had to provide to them so that they could provide it to their board. Um, I would say that their whole philosophy, and I think this is, for anyone thinking about M&A, and I know this is your deep expertise, their whole philosophy was do no harm. So after they bought the company, they really did very little integration. And then the second thing was when I came to the board meeting was come with an ask. Like, don't just sit there and give us a report. Like, our job is to help you. So come with an ask and we'll see what we can do to help you with whatever that ask is. I loved those two elements. I think
Yeah,
the only
that,
thing
that's
that,
great.
was hard for me is, there is a lot of extra meetings that I had to attend to because, being a publicly traded company and a larger company with lots of stakeholders, there was lots of things that I had to report to those different stakeholders. And I think that that is a very normal expectation. Like if you're going to sell to a large company, you should, as the CEO, understand that that's going to be a big part of your new roles and responsibilities is the managing up and making sure that those stakeholders have the information they need.
How much freedom did you have to to get out of this minority partnership before going all in and doing another transaction with them?
I honestly have no idea.
Well, I mean, it's good that you didn't need to know.
Yeah. Um, I mean, it never even crossed my mind, so I really don't know.
Well, because I find it interesting because they locked you in, right? They found a great partner. They're building on the relationship. They did a minority, purchase. They continue to invest in you and support you. You continue to grow during that period of time. And then, how many years later before the majority investment
Years
happened?
later, 2 years later, I did the majority, and then I did a 2-year earnout.
So, how much growth did you realize during that period of time that was different than what you would have realized independently?
So, I mean, if I had to
I'm
say
trying to find
one,
out how much they actually helped you because you were growing pretty
yeah.
good on your own, John. That's my point.
So I would say that the vast majority of the growth came from Rise, and the impact that Quad had came much later. And this is actually something, if anyone is thinking about M&A, whether they're buying a company or selling a company, is oftentimes the synergies are overestimated by the buyer or the seller in terms of what the deal was. So in their scenario, um, their client, like everything I said about the thesis was true. Very large sales force, lots of tier one clients and relationships all the way up to the C-suite. And they made tons of introductions. They worked on getting their sales team trained, but they were moving as a printer to a new category. And it took a long time, I think, for the market perception to accept and change, accept that it's kind of like if, you know, Anheuser-Busch started selling, water, like you might feel, like that. I don't know if that's the water I want to buy, as opposed to they sell beer. And actually, someone gave me a good example. I think it was them who went into the snack business. And, because it's like, hey, we're giving you the drinks, we'll give you salty snacks that go along with it. And it was a complete bust. And I've heard numerous stories of friends of mine who sold to a tangential business, but it wasn't like completely like exactly what they do. And those
Right.
synergies come a little bit later. But I do believe
Yeah.
after I sold, from what I understand, they had a very big impact in the growth of Rise.
It's interesting. The synergistic multiplier on any transaction should be conservative in nature. You should forecast do no harm, which would mean not a lot of expectation around growth and synergies being realized or cross selling. It's fantastic that you had a partner, a buyer that understood it. And that's not always the case. Maybe unpack for the listener the difference between these three types of transactions that you went through. One was a minority transaction, so you negotiated that. And then you had the majority. Was it
Yeah,
pre-negotiated or was it negotiated again?
it was negotiated again. So second
Yeah.
negotiation.
So basically valuing the business again, looking at the
Yeah.
forecast, which they've been seeing, they know what's going on, and then an earnout structured as a back end for that. What
And that
about
was
that
good.
process? Yeah, unpack that for listeners. So how did you maximize that negotiation? You said you wouldn't change anything. What did you learn about negotiating future performance expectations, if anything?
You know, I did incredibly well on the earnout, so it's part of the reason why I wouldn't like renegotiate. I have heard of horror stories where people, crushed the earnouts and the guys didn't have the money to pay them. I've heard stories where they got an earnout and they didn't achieve any of the earnouts. And so I'm fortunate that the outcome worked really well for me. But so that's why I say like I really like the structure they had and what they put in place. And so I wouldn't really change anything in terms of how the deal was structured. I think,
Would you attribute that to your confidence in the business? Like you knew it was going to perform, so you were comfortable with those parameters? Like what would
yeah, I
I'm
mean,
just trying to get into like there's a delta between what people have as an expectation in their performance earnouts and then you and many of my friends crush their earnouts and they're very satisfied with the second bite.
I felt really confident in our ability to still be able to, like, I felt like there was still lots of room for growth in Rise. If you take performance marketing today, WPP just announced their earnings and their profits are way down. And, with AI coming up, there's a lot of headwinds. My friend, I don't know if there are headwinds. There's a lot of uncertainty in the marketing services sector. I might be more concerned today on the earnout because of macro factors that are beyond my control. I think I mentioned this to you, my half Ironman story about my first half Ironman and the bike ride into the wind. Did I tell you this?
Yes, but you need to now retell it because
Okay.
We both, by the way, for the listener, for those who know me, know I do half Ironmans and triathlon and endurance racing. John does them too, not as frequently. We'll potentially have to change that, John. You got to come back.
Uh, I am training for a 2.4 mile swim, so I'm like a third of the way there for an Ironman. But uh, my first half Ironman is in a place called Mattoon, Illinois, which is the middle of nowhere, Illinois, surrounded by farmland, no trees, and it is a freezing cold September day. Winds are about 25 miles per hour, and you're on one road, you go 28 miles one direction, you turn around, you go 28 miles back. And I'm going out, and I typically average about 20 miles per hour. On the way out, I was going straight into the wind, and I was averaging between 6 to 8 miles per hour. On the way back, I was going between 30 to 35 miles per hour. And to be honest, I could have gone faster. I just was scared. I was like, I don't know if I want to wipe out at 40 miles per hour. So, but I really think that this is very similar to business, is a huge part of the success of Rise. With all the things that I just mentioned and the intensity and the exam and the technology and the granularity and all that great stuff, I also was very fortunate that massive amounts of media was leaving traditional media and moving into digital media. So I had wind at my back. And so I was going 30 to 35 miles per hour because I had wind at my back. It was easier to pedal. When I look at marketing services today, uh, with I don't know if it's 6 to 8 miles per hour, but it might not be the 20 that I was averaging. It might only be, and so I really want people to think about the customers they serve and do they have wind at their back? And then I also want you to think about the services that you provide. Do you have wind at your back? So would I do the same earnout today? I'd be much more reluctant because I feel like there's a bigger risk factor going on.
Would you say then that the buyers are also using that level of scrutiny when evaluating the future performance of the businesses and structuring deals?
They should. I would say that it goes both ways, that, the buyer wants to de-risk themselves and the seller wants to de-risk themselves. And so you need to come up with a fair deal, based on, you know, the uncertainty. You guys might, whoever the seller is might have a great strategy, or the buyer might have a great strategy of how they're going to take advantage of AI. AI is going to be a disruptor. If you think about, trading, where people used to trade on the floor and then all of a sudden came high frequency trading with computers, there are a lot of companies that made a lot of money that are still making a lot of money because they made all the investments in the technology and they recognize that this change is actually really good for us. And so if you have a good vision for how you're going to leverage AI, that could be a really good thing.
What about your team? So, when you were going through these various stages of selling the business, what was the total timeline from when you first did your transaction to where you left after your earnout? How many years is that?
So June 2006 is when we did the minority deal. And then April of 2020 is when I exited the business. So it's about 3.5, 4 years.
Okay. What was the energy conversation? What was the team's take on your partnership and your eventual exit?
Uh, I think the team was supportive of it. What I'd say is these are emotional times, and everyone is very worried about what's their new role going to look like, what's the world look like, are they going to participate in this? So, you know, you definitely have to have a right strategy. And I honestly don't know what that exact right strategy is yet, but really making sure that your leadership team is on board with this and excited about the new process, because you want to maintain that entity, or that intensity. A large percentage of the leadership team is, stayed for many years. Some have moved on, but some of them are still there 5 years after I exited the company. And what I would say is everyone's different. This is important to me. I really want this to be a win-win deal. So like when you sell a company, you know, I don't want you to be selling garbage, but convincing somebody that it's gold. I want you to sell something so that the buyer gets true value out of it. Because, I feel really good. They made a great return off of the investment. And that means a lot to me. As I said, they're wonderful people. They did right by me. And I love the fact that if they ever sell this, that they'll sell it for a lot more than what they gave me, so which is what you're hoping for, in my opinion.
Yeah. So you finish your earnout. What did your exit look like? Did they just secretly bring you out the back? Was it a goodbye John party? What did those final days look like?
I think very different than anyone expected. So I made the decision in October of 2019. I told them in January of 2020, and then I announced to the company in March 2nd of 2020. And then in March 12th, we went to a work from home policy because of COVID. And so there was no goodbye parties or anything like that. Everything was virtual at that moment in time. And, you know,
So you just logged off and they didn't say that. That's a crazy time to exit, John.
it really is. And you know what? It's also, I feel bad, but, I turned this over to, the president of the company to become the new CEO. And I was like, good luck, because you have to deal with a worldwide pandemic. But he honestly was the right person for the job. He did such an amazing job during that time period. I stayed on for 6 months as a advisor or consultant, and spent about half my time, really trying to make sure that, um, if Larry, the new CEO, needed me at all, if Quan needed me at all, I made myself, available. So it wasn't like a complete exit on April 1st of 2020. And then October 1st of 2020, I was officially out of the business.
So what did that look like? So you're officially out. You got young kids.
Yeah.
You've been in the grind. You've been transacting a business. You've been slowly, hopefully, weaning them off of you during that period of time. But what did it look like to have no one emailing you anymore after that long of a run?
I started Fiscal Advocate right away. Like Larry was the CEO that replaced me. Like if you asked him, he's like, the one thing that he is angry about is that I didn't take like any time like to do anything fun. I did this. I trained for a Century bike ride. So that was fun for me. You'll appreciate this, but the day of the Century bike ride, there was no formal races because it was COVID. So I just went for a 100-mile bike ride on my own. And mile 7, my bike breaks down of the actual official race day. And it took 2 years to get the part that I needed. So I never got to actually do the race. I ended up doing it on my Peloton, which I don't recommend to anybody. 100
No,
miles.
don't. This, we'll put that in the don't recommend category. I have a 116-kilometer bike ride on Saturday. We'll approach maybe 80-ish miles. Don't do that on a trainer. Don't do that on a pellet.
Yeah. But that was my only option.
Wait, let me just run through. Let me just make sure the listener knows this. You went university to first attempt at an agency, business school, second attempt at an agency, drove hard for years and years and years and years, sold, supported them in the transition, was available to them, and started your other business without taking a holiday.
Yes.
Doug, we're learning a lot about you. When's your bike ride across the United States scheduled?
I actually love that idea. I might have to think about when that happens. But let me just tell you, from my perspective, I wake up every day and love what I do. So, yes, I'm working hard. But if you enjoy what you're doing and it doesn't feel like work to you, then I feel very fortunate. Uh, you also have to remember the airports and the golf courses were closed April of 2020. It wasn't like,
You didn't have a lot
you
of
know,
choices. Yeah.
think about creating a large company and you think about what you're going to do with your time. And it all generally involves an airplane. So, me starting this business, it made sense to me. Now, every summer for the last, not this summer, this is the summer we decided to stay home. I've gone on 3 major trips, so it's not like I'm just working 24/7. I'm doing some cool things, but just done it a little bit differently.
What made you decide to get into the category you're in now? So, for a listener, you have Fiscal Advocate. That
Yep.
was this new project that you launched. You talk about waking up and being passionate about it like you were with the agency. And most people don't do a transaction unless they know what they're going to do after. So explain a little bit about this next chapter of life and why it keeps you
Yeah.
so invigorated as a vocation.
So when I grew Rise, I mentioned like gross margin, I mentioned like percent of revenue that goes into sales and marketing. I really believe there's gold in your financial data. And I don't think that companies understand that and know how to use it. And so I thought it'd be really fun to help other entrepreneurs grow faster, increase their cash, and increase their profits by helping them understand how to leverage this financial data. So I built technology called Engine BI, and then we manage all of your finances. I personally do strategic planning, and I really love working with these entrepreneurs. I like to use this as a story. One of my clients was Fortune 13 at Rise. And every single thing about that client is amazing. The people were great to work with. The amount they paid us was amazing. The quality of work and what we were doing was great. However, if a new CEO came in and said, you know what, I want you to fire Rise. And not only do I want you to fire Rise, I want you to stop and completely what they're doing. We're not going to even replace them. I think they would have gone from Fortune 13 to Fortune 13, where, I have a client of mine between 10 and 15 million in revenue. Last year, before I got involved, they were losing a ton of money. They had, in my opinion, an overpriced CFO that was making all sorts of mistakes. And building up debt, we helped them completely turn around their financials. We put a budgeting and forecasting in place. We put 13-week cash flow analysis. And the amount of profit they made just in the month of May is beyond crazy. And they're now growing. We're now having strategic conversations about investments to make in sales and marketing and innovation and cool things to do. And I can feel the impact, from the starting point of person is stressed and not sleeping well at night to now they're like waking up and they're having a hard time sleeping because they're so excited about all the things that they get to do. And so I just find it really rewarding.
For the listener who says, John, you're a unicorn. I have not experienced agency life the way you have. I want to sell in the future. What advice do you have for them?
So a couple of things. The first one is I'm going to go back to the wind. Whether the service you're offering or the customers your service, you have to have wind at your back. It is really, business is hard. Okay. And I promise you, you're hearing about all the successes. There was a lot of grinding and a lot of tough emotional time periods and, things that you have to weather through. No different than training for a half Ironman, right? Like there's times you just don't want to get in that bike ride or just get in that pool, but you feel great when you go through the actual event and you cross that finish line. The second thing is I really believe in this idea of build an amazing business. If your business is better at the end of the year than it was at the beginning of the year, and what I mean by better is the quality of the service you provide, the sales and marketing machine that you've built, like if you just keep on making everything a little bit better, and you can hold on to your customers, you'll build something special. If you can't hold on to your customers, you're going to have a tough business.
John, if the listener wants to learn more about your journey or your current position of supporting founders by understanding the gold that's in their financials, what's the best way for them to reach out to you?
You can follow me on LinkedIn. I post 3 times a week, every Monday, Wednesday, and Friday. I write at fiscaladvocate.com regularly in our blog, and you can email me at jon@fiscaladvocate.com.
John, you practice what you preach, man, and I appreciate it. I'll follow up about our bike ride across America here pretty soon. Thank you for joining me.
Honored to be here, Peter. Thank you.